From March 20th, 2026, your age pension payment is set to change. For many Australian seniors, that could mean a higher amount landing in your bank account. But here is what often gets missed in the excitement of a pension increase headline. When payments rise, other rules can shift at the same time. This is not about alarm. It's about being informed. Twice every year, the Australian government adjusts the age pension through a process called indexation. The policy settings are handled by the Department of Social Services, and your payments are delivered by Services Australia. On paper, a fortnightly increase sounds simple, but your actual outcome depends on whether you receive the full rate, a part rate, or if you are close to the income or assets limits. Small technical changes can mean the difference between a clear boost or a smaller than expected rise. More than 2.5 million age pensioners are affected by indexation adjustments. If you rely on this payment for groceries, rent, electricity, or medical costs, even a modest change matters over the course of a year. In this video, we will break it down clearly. How much is increasing? Who benefits most? And what other rule changes you need to understand before March 2026 arrives. Because the real question is not just, is there an increase? The real question is, how will this affect me personally? Every March and September, age pension rates are reviewed under Australia's indexation system. This is not a political promise. It is built into legislation. The purpose is simple, to help pensions keep pace with the cost of living. In March 2026, payments are being adjusted again because inflation data and pensioner cost of living indexes have moved over the past 6 months. These adjustments are calculated using a mix of the Consumer Price Index, CPI, the Pensioner and Beneficiary Living Cost Index, PBLCI, and wage benchmarks. In plain English, if prices rise, pensions are reassessed. Now here is what matters in 2026. Over the past year, Australian seniors have faced continued pressure from grocery costs, insurance premiums, electricity prices, and medical expenses. Even small increases in everyday essentials add up quickly when you are on a fixed income. That is why March indexation is closely watched. For a full-rate single pensioner, early projections indicate an increase of roughly $20+ per fortnight. For couples combined, the rise is larger overall, though split between partners. It may not sound dramatic at first glance, but over 12 months, even a $20 per fortnight increase equals more than $500 per year. For many retirees, that covers several power bills, extra medical appointments, or unexpected car repairs. It's also important to understand that this change happens automatically. You do not need to apply. If you are eligible for the age pension before March 20th, 2026, the updated rate flows through your regular payment cycle after that date. However, and this is critical, indexation is only one side of the story. Income thresholds, asset limits, and deeming settings can also move in March. So while the headline says, increase, your personal outcome depends on your financial position. And that is exactly what we will break down next, the actual numbers. Now let's move from headlines to hard numbers. As of the September 2025 rates, a full-rate single-age pensioner receives approximately $1,178 per fortnight. That figure includes the base pension, the pension supplement, and the energy supplement combined. For couples, the full combined rate is approximately $1,777 per fortnight, which works out to around $888 per person. From March 20th, 2026, indexation is expected to lift these figures by roughly $20 to $25 per fortnight for singles. Couples combined are projected to see an increase of around $30 to $40 per fortnight, shared between partners. Let's break that down clearly. If you are a full-rate single pensioner and your payment increases by, for example, $22 per fortnight, that equals around $572 extra over 12 months. If you are part of a couple and your combined increase is around $36 per fortnight, that equals roughly $936 extra per year as a household. Now here is something many people misunderstand. The age pension is not just one flat number. It has three main components: the base rate, the pension supplement, the energy supplement. When indexation occurs, the base rate is adjusted first. The supplements may also move depending on legislation and previous freezes. If you receive a part-rate pension, your increase will depend on how close you are to the income and assets limits. Someone just slightly under the threshold will likely see the full increase. Someone closer to the cutoff may see a smaller rise. This is where income testing matters. The age pension has two separate tests: the income test, the assets test. Whichever test results in the lower payment is the one that applies to you. So if thresholds shift in March 2026, some pensioners may qualify for a slightly higher payment beyond the basic indexation amount. Others may remain largely unchanged if they are already near the maximum limits. And remember the timing. The new rates apply from March 20th, 2026. That means the first payment reflecting the increase will depend on your normal reporting and payment cycle. Some recipients will see it within days. Others may see it in the following fortnight. The key takeaway here is this: the big increase headline refers to indexation. For most full-rate pensioners, it means a modest but meaningful rise. But your exact figure depends entirely on your personal financial situation. And in the next section, we need to talk about the part that catches many retirees off guard: deeming rates and hidden offs, TS. Now we need to address the part that rarely makes the headlines. Yes, March 2026 brings indexation, but it may also bring adjustments to deeming rates and financial thresholds. And this is where some pensioners get caught off guard. First, let's clear up a common myth. Myth number 1. This is a bonus payment. No, this is not a one-off cost of living bonus. It is a scheduled indexation adjustment built into the system. It increases your base rate, but it does not override the income and assets tests. Myth number 2. Everyone will receive the full increase. Not necessarily. If you are on a part-rate pension and your income from investments, superannuation, or savings is assessed under the deeming rules, changes in deeming settings can affect how much pension you receive. Deeming is the method used by the Services Australia to calculate assumed income from your financial assets, regardless of what you actually earn. For example, if deeming rates increase in March 2026, the government may assume you are earning more income from your savings. That higher assessed income can reduce your pension under the income test. So while your base pension rate goes up through indexation, your assessed income might also rise, partially offsetting the increase. Here is a simple scenario. Imagine a single pensioner with substantial savings sitting just under the income threshold. If deeming rates rise, their assessed income could increase enough to reduce their pension by a small amount. In that case, the net gain from indexation might be smaller than expected. On the other hand, a full-rate pensioner well below both income and assets limits is likely to receive the full increase without reduction. This is why context matters. Another area of confusion involves asset limits. If asset thresholds increase slightly in March, some people who were previously receiving a lower part-rate pension could see a small improvement beyond standard indexation. But again, it depends entirely on your financial position. The important message here is not to panic. This is not about alarm. It is about understanding the moving parts. Indexation increases the headline rate. Deeming and means testing determine your personal result. And in the final section, we will focus on what you should do right now to make sure you are not caught by surprise. So now the big question. What should you actually do before March 20th, 2026? First, check your details. Log into your MyGov account and review your information linked to Services Australia. Make sure your bank details, address, relationship status, and asset declarations are up to date. Even small inaccuracies can delay adjustments or trigger reviews. Second, understand where you sit under the means tests. If you are a full-rate pensioner comfortably below the income and assets thresholds, you are likely to receive the full indexation increase. If you are on a part-rate pension and close to the cutoff limits, it is worth reviewing your financial position. A change in deeming or thresholds could slightly alter your entitlement, up or down. Third, do not make rushed financial moves. Some retirees hear about deeming changes and immediately shift money between accounts, redraw superannuation, or move funds into different structures. That can create unintended consequences. Before moving large sums, consider speaking with a licensed financial advisor who understands age pension rules. The interaction between superannuation income streams, bank savings, and the income test can be complex. Fourth, watch your payment notice. After March 20th, 2026, you will receive an updated rate letter through MyGov or by post. This notice will clearly show your new fortnightly rate, the income figure used in the assessment, the assets value applied, which test determined your payment. Take 5 minutes to read it carefully. Many pensioners ignore these letters, and that is where confusion begins. Finally, remember this. Indexation is designed to protect purchasing power over time. It is not designed to create windfalls. For most full-rate pensioners, March 2026 will mean a modest but helpful increase across the year. But the real protection comes from understanding how the system works. Because when you understand the rules, you are not reacting to headlines. You are making informed decisions. Let's bring this together clearly. From March 20th, 2026, age pension rates are scheduled to increase under the regular indexation system. For a full-rate single pensioner, that likely means roughly $20+ extra per fortnight. For couples combined, the increase is higher overall, shared between both partners. Over a full year, that can translate into several $100s in additional support. But the headline number is only part of the story. Your actual outcome depends on 3 key factors: whether you receive the full rate or part rate, where you sit under the income test, where you sit under the assets test. Deeming rules may also influence how much of that increase you ultimately keep. For most full-rate pensioners well below the thresholds, March 2026 should result in a straightforward rise. For those closer to the limits, the final figure may vary. This is not about alarm. It is about clarity. The system is designed to adjust with economic conditions, and these changes happen twice each year. The next scheduled review after March will occur in September 2026. So here is your action plan. Check your MyGov account. Review your updated rate notice. Understand which test applies to you. And most importantly, do not rely on social media headlines for financial decisions. If you found this breakdown helpful, share it with another Australian senior or pensioner who may be confused about the March changes. Staying informed protects your income, because when it comes to your retirement support, small details make a big difference.